This Red Rock at the moment is a natural resource recovery play. We've been a recovery play in the past. From 2008 to 2010, the price went up 60 times. It probably went up too much, but we have, in recovery since then, we've outperformed when the market's gone up and underperformed when it's come down. We're trying to provide some protection against that underperformance by creating revenue streams in the company so that we have a firmer base and protection next time the market goes down. But recoveries, we know all about. We know how to seize the opportunities when the market and commodities are going up. We have petroleum and mining assets. The two commodities we're majoring on are gold and oil. Our focus is on near-term cash generation, and that is perhaps a change from the past in that we, first of all, we have the opportunity to do this, particularly in oil, which we didn't in the past. And secondly, we perceive the structure of the AIM market as a market for exploration companies that didn't have cash flow is not a structure that works well at the moment, that without cash flow, one is too vulnerable to the vagaries of the market. We have some historic assets left over from our past because we saw ourselves always as a digestive system that added value, passed things on to bigger companies with lower costs of capital. That worked in the upcycle, but from 2011 onwards, we've tried to dispose of some assets. The buyers weren't there because even the big companies were cutting back rather than looking for things. So we have some legacy assets that have huge value in the balance sheet and which the value in our view is greater than the company's value. We're not spending money on them, but they will eventually give us a benefit. The bottom of the cycle is when you find opportunities. That's where we are now. We've been through the stage of capitulation and we're in the stage of depression. As an example of that, I give the oil market, where the bottom was $27 a couple of months ago. Since then, it's gone up to $41, $43, and yet all the headlines have been, on every day it went down, after a few days of going up, oil falls again. So anyone just reading the headlines rather than the numbers would be convinced that it's continued falling the last 2 months. That's what happens when people are depressed. The psychological truth takes over from the reality, and it takes time for people to realize that they've just missed the best opportunity where the 50% rises are, which is the bottom of the cycle. We are well positioned for outperformance with multiple cash flow streams. This is our revenue timeline. By the way, also from here, we turned our office costs around so that our office costs are now a profit center instead of a cost. And that means that if you take out administrative costs and revenues, we probably have some of the lowest costs of administration of any company listed on AIM today, other than a pure complete shell. The LM20 well in Louisiana came into production and is producing cash flows to us. We received a progress payment from our sale of our gold asset that we put into production in Colombia. The next quarters will start producing revenues from 4 more wells, with further progress next year. We will also start getting royalties from Colombia, from the gold there, from May onwards. And we'll get further progress payment there, and we expect to be able to accelerate payment of $1 million promissory note because they managed to get that company listed in Canada but bought from us, and the condition was we could then convert to shares. It's a $16, $17 million company now, so that shouldn't be a problem. And then at the end of the year onwards, one of our legacy assets, where we only have 1.2%, but it's probably worth more than the entire capitalization of the company, we should start seeing the potential for dividends. That's been a very successful company, will be where your grandchildren, when they're using knives and forks, it'll contain manganese from this mine, I'm sure. Shoats Creek, which is our oil asset in Louisiana, we have a 14.4% net revenue interest, 20% working interest. Our partner also with a 20% working interest, is Northcote, also listed in London. We work very closely with them. The low geological risk in this horizon, cheap wells, the price has been coming down of drilling all the time, and the ongoing cost of production per barrel, $10 or less, we anticipate. That's a map of it. This will go up on our website so you can see it later. I think it's difficult for you to see at that distance, and there's not much point in my going into the detail in a very short presentation like this one. So this is a summary. We are producing over 200 barrels a day from this first well. We think the second will be about the same. The third should be the best at about 350 barrels, perhaps. And we're targeting over 100,000 barrels per well over the first 3 years or so. And we'll be building up our own production rapidly. And there's plenty of scope for expansion of what we're doing at the moment. No need really to look for anything else in terms of rate of return, present value. It's a really good deal. We're in there now on the same terms as everyone else. And we can drill one cheap well after another and get hundreds of barrels for the consortium of cheap oil after hundreds of barrels of cheap oil as we drill these wells sequentially. 2 other horizons, we won't go into that now, but one at least, the Cockfield, has some of the same characteristics which in other words, cheap. It produces more gas. As we put the gas from the Frio wells with the gas from the first Cockfield well this year together, it'll reach a critical mass when it'll become worthwhile for a gas company to put that 2 million cubic feet a day or so of gas production to pay for the spur to get it into the network. At the moment, from the LM20, we're flaring off 250,000 cubic feet a day of gas. And economics, summary there of what I told you. Even at an 18% conservative discount rate, even when the oil price was $30 compared with the current 43 or so, maybe 45 for this oil, we were getting a positive return. So we're getting a very positive return now. Also, it appears that the profile of the field, the depletion in the first year, is going to be, in the production rate, is going to be less than we expected. We have to wait to see that, of course, but that's the indication. Regional play also. Jupiter Mines, I described that. And, whoops. The interest we have there, as I say, is very valuable. We expect to get dividends. This is the Colombian asset. And we have 1 or 2 other things that we haven't really brought into the discussion. The Migori Gold Project, 1.2 million ounces of gold, easily expandable with more exploration, very similar to North Mara, run by Acacia just to the south. There's been a dispute between our local partner and the Kenyan government. We've taken the Kenyan government to court. At the moment, I'd say the market is valuing this at nothing, but we expect to be able to solve it and get it back. These are the basic figures about the company. We will be growing this company a lot this year. We'll have multiple revenue streams. We are working with our friends to turn around a number of other companies which have seen very substantial price appreciation. The same team will be working on this, and you'll see some action. Any questions? Then I think we're finished. Thank you very much.